All right, welcome. Today, we're going to pull back the curtain on a super powerful concept that's always working, kind of silently, in the background of our global economy. It's called hedging. Think of it like a financial shield, and I promise, by the end of this, you'll get exactly how it works and why it is so important. So let's kick things off with a real-world puzzle. You've seen it, right? Fuel prices suddenly jump, but the airlines don't just immediately grind to a halt or double their ticket prices overnight. So how do they handle that massive, unpredictable cost? Well, the answer is hedging, and it's the key to navigating all this financial uncertainty.
Okay, so before we can really get into how this shield works, we've got to understand what we're shielding ourselves from. The financial world, it's in constant motion, and that motion creates these unpredictable risks. You could call them financial storms that can affect pretty much everyone, from giant corporations all the way down to individual investors like you and me.
Now, risk isn't just one big scary thing. It actually have a bunch of different faces. You've got market risk. That's when your stock portfolio could just drop. There's currency risk. Say you're an importer and the exchange rate suddenly goes against you. And of course, commodity risk. That's our airline example, worrying about the price of jet fuel. Any one of these can have a huge impact. So how in the world do you protect yourself from all that stuff? That's where hedging comes in. And here's the most important thing to get your head around. Hedging is a defensive strategy. It's all about protecting the value you already have. It's the total opposite of speculating, where you're actively trying to make a profit from those crazy price swings. Okay, so here's the official textbook definition. Hedging is a technique used to reduce the impact of adverse price movements. Basically, the whole idea is to take an opposing bet, so that if your main investment loses money, your hedge makes money, and they cancel each other out. And honestly, if you remember one thing, let it be this. It's just like insurance. You pay a premium for your car insurance, right? It's a small known cost to protect you against the huge unknown cost of a major accident. Hedging is the exact same idea. You accept a small cost to protect against a giant potential loss. You're literally buying yourself some peace of mind. Okay, so that's the big idea. But what does this financial insurance actually look like? How does it work in practice? Let's walk through a really simple example and see the mechanics of it in action.
So let's just imagine you've got a stock portfolio, and it's worth 10 lakh rupees. You've done pretty well for yourself, but you're starting to get a little bit nervous that the market might be heading for a downturn in the next few months. You want to protect those gains. And here's where the magic happens. Watch this. Let's say your fears come true and bam, the market drops 10%. Your shares lose 1 lakh in value. Bummer. But because you put on that hedge, that opposing bet, that position gains almost the exact same amount. So what's the bottom line? Your net loss is pretty much zero. The loss on one side was almost perfectly canceled out by the gain on the other. Now, you didn't make a profit, but, and this is the crucial part, you didn't lose your capital either. That shield you put up, it did its job perfectly. All right, so that was a simple example for one person. Now let's zoom out and see how this thing plays out in the real world, because this isn't just a strategy for you and me. Hedging is a massive, almost invisible force that keeps entire industries and the whole global economy stable. So when the pros build these shields, they've got a whole toolbox. The big three are futures, which let you lock in a price today for something you're going to buy or sell later. Then there are options, which are cool. They give you the right to trade at a certain price, but you're not obligated to. And then you've got swaps, where two different companies literally just trade their financial risks with each other. And you'd be surprised who's using these tools. I mean, it's pretty much everyone working away behind the scenes. That airline we keep talking about, they use oil futures to lock in their fuel costs for months, even years in advance. An importer might use something called a forward contract to protect against a bad currency swing. Banks use swaps all the time. And investors, well, they might use index futures or options to protect an entire portfolio. This is such a perfect way to see how it all fits together. Think of it like a tale of two traders. On one side, you've got an oil importer. Their biggest fear is that prices will go up, which would kill their profits. So they hedge by agreeing to buy oil at a fixed price in the future. On the other side, you've got an oil producer. Their biggest fear is that prices will go down, which would destroy their business. So they hedge by agreeing to sell their oil at that same fixed price. See, they have opposite fears, and hedging helps both of them sleep at night. Okay, but here's the thing. This protection, this wonderful stability, it's not free. And this is probably the most important trade-off you have to understand when it comes to hedging. It's a decision you have to weigh very, very carefully. On the one hand, the advantages are pretty obvious, right?
you cut down on potential losses, and you make your future a lot more predictable. But, and this is a big but, there are downsides. Hedging costs money, that's your insurance premium. And, this is a big one, it can cap your potential profits. If that market you hedged against suddenly takes off like a rocket, well, you miss out on those surprise gains. You're basically trading a potential windfall to avoid a potential disaster. And you have to be careful, because sometimes these tools can get so complex they create their own hidden risks if you don't know what you're doing.
So, when you strip it all the way, hedging really comes down to one single powerful question. It's not just about managing money or products, it's about managing uncertainty itself. It forces you to ask yourself, what price are you truly willing to pay for peace of mind?